Hi guys, welcome back to Father and Son Investing. This video is going to introduce a concept to you that can help increase your dividend yield from certain types of dividend yield paying stocks. It won't work for every dividend yield paying stock you have, but I will show you how this works. If you stick around to the end of the video, I'm going to give you two companies that you can do some homework on that will give you returns of 62% and 41%. This is the dividend yield on these particular stocks. Stick around. To introduce this strategy, I want to talk about common stocks and preferred stocks. Now, some of you may be thinking preferred stocks, I'm not interested in them, and you just want to hit the stop button. Before you do that, please just stick with this and let me explain how this works and why it can be beneficial to you. Common stocks, some attributes of those. Obviously, some common stocks do pay dividends. That's what we're talking about here. The dividend, though, is paid last compared to everyone else above the common stock holders, and it's variable or may not happen at all. When it comes to growth in share price of the common stock, that's where common stocks are favorable here. They certainly will have the most growth in share price potentially. When it comes to liquidation, if the company fails, common shareholders are on the bottom of the food chain. When it comes to voting rights, they do get to vote for directors or other entities within the company, or whether mergers will take place, etc. Arrears of a missed dividend, common stock shareholders have no rights to that. And of course, as I mentioned, the dividend is not certain. Now, preferred stocks. Before we hit preferred stocks, I want to talk about bonds and stocks and how they differ, because we'll see that preferred stocks are kind of a blend of both of them. All right, stocks and bonds. A stock is obviously equity in a company. If you purchase a stock, you're purchasing a small share of ownership. If you are purchasing a bond, you are purchasing a debt that the company has issued out and that they will be paying interest on. So return on a bond obviously is interest. Return on a stock, if applicable, is going to be a dividend. Now, there is no guarantee that a dividend will be paid versus there's pretty much a guarantee that the interest rate on a bond is going to be paid. And then when it comes to additional benefits, of course, the stockholder has voting rights. When it comes to a bondholder, in a liquidation event, a bondholder has a higher rung in terms of being able to recover their investment than a common stockholder has. So with that concept in mind, let's just compare all three of these: common stock, preferred stock, and bonds. We will see that preferred stock is sort of a mixture or shares some attributes of common stock and of bonds. When it comes to the structure, of course, preferred shares are equity shares. When it comes to liquidation preference, it's in between. They don't have as high ability to recollect their investment as a bondholder has, but they're not as low on the rung as a common stock. When it comes to the risk, it's also a blend. It's sort of in between. And when it comes to voting rights, it is more like a bond. There are no voting rights, or those voting rights are negotiated. When it comes to growth limits, there are growth limits potentially on preferred stock. They generally are not going to grow to the same extent as a common share will. And when it comes to dividend, it's fixed like a bond. It is a fixed dividend. But it has some better features than the common stock in that you can have arrears, or if a dividend payment is missed with certain types of preferred stock, you can collect arrears. Those are called cumulative preferred shares. Now, there are lots of type of preferred shares. I mentioned the cumulative one, that again will pay you arrears in dividends. There are non-cumulative preferred shares which don't do that. There are convertible preferred shares which are convertible into common shares under certain conditions. And a type that I like is perpetual, meaning that there is no expiration date on this, and there are some other types there as well. With that in mind, I want to introduce a certain type of cumulative preferred share that I purchased. It's called OTRK.P. OTRK is the regular ticker symbol for on track, and then OTRK.P for the preferred shares. Back around early March, the share price plummeted. On track had lost one of their customers, Aetna, and when that happened, people freaked out, and both the price of these as well as the regular on track shares decreased significantly. Now, when that happened, I looked at these shares, and I said, oh, wait a minute, there's a buying opportunity here that will pay me a higher dividend yield. How does that work? We're going to dig down into the particulars of this particular type of share. We can see that it was issued at 9.5%, that is the dividend yield, and that is a cumulative perpetual preferred stock. I love that kind. Now, this was based on a redemption value of $25 per share. That means that if this company goes into bankruptcy, the value of these shares is $25. Or if they choose to redeem these shares, purchase them back from me, they will pay $25 regardless of what price I paid for it. We also see that that can't happen according to the way the structure was set up until at least August 25 of 2025. So I will collect that dividend at least until then, and potentially after, even if they choose not to redeem these shares or purchase them back from me. We can also see in here that at least for this particular structure, the way that they organized the sale of these shares, they pre-funded the dividend until at least August of 2022. So there should be no reason why they miss a dividend payment until then. And hopefully the company will be doing well financially and won't miss payments after that. So that is the crux of this strategy, finding preferred shares that are currently selling for less than their redemption value. Now, to illustrate this, I'm going to turn to a spreadsheet, and here comes the two companies that I promised I would give you if you stuck around. This is a spreadsheet that lists approximately 600 different types of preferred shares that are being sold in America. Now, I have pre-sorted this spreadsheet based upon the current dividend yield. The top two companies here are the ones that I'm going to give you. Regional Health, they have a cumulative preferred type of share. And Washington Prime also has a cumulative preferred type of stock that they are selling. Regional Health, it goes by RHE with the addition of an A, so that can be dash A or sometimes decimal point A. And Washington Prime is WPG. It comes in two different types depending on the dividend yield, the coupon yield, and those are WPG-I or WPG-H. We can see that the liquidation price for these, generally $25, is pretty common, and that is the case for these two companies. And we can then move over to the last end of day price. We'll see that Regional Health was trading at $4.40, and Washington Prime was trading at either $4.17 or $4.57. Of course, we already talked about the coupon rate there, so we'll move over to the current rate. The current dividend is 62% then for Regional Health, and it is 41% for the Washington Prime. Now, how is that possible? It's because the dividend is based on the liquidation price of $25, but the current price is only $4.40 or $4.17 or $4.57, depending on which company you're interested in purchasing. So you're going to pay $4.40, but you're going to get the dividend based on $25. And thus, if you do the math, you're coming out around 62% or 41% for whichever of those companies you decide. Now, there are obviously more companies that are doing this. I chose OTRK.P, but if we just concentrate on this type of strategy, it can be risky because there are reasons why these shares are trading so far below their liquidation price. You have to look into what those might be. I'm going to do some of the homework for you on Regional Health, and we're going to look at how their share was set up when they issued this. This is from 2017. It was an update to from their perspective in 2015. Back then, the company was called AdCare. They were doing long-term care facilities, and they restructured their company into a REIT, which is a real estate investment trust, such that they just own the properties and they rent them out now to companies who are providing long-term care. Back then, they set this up again at a price or a liquidation price of $25, and the dividend yield was set at 10.875%. They also included a date by which, at their choosing, they could choose to rebuy these shares back from the shareholders. That was December 1st of 2017, so that date has already passed. And so now, at any time, they could come back and buy these shares for $25. Not bad. You buy them for $4.44, and if they want to buy them from you, you're going to get paid $25. Now, again, it's important to dig down into the particulars of the offering. One nice thing about this particular offering is that should they miss dividend payments for certain amounts of time, and it's listed in here what those are, they will pay a penalty interest rate of 12.875%. So an additional 2% is added in there if they don't meet the dividend for the, again, the listed amount of time here. So there you have it. The crux of the strategy is finding preferred cumulative and hopefully perpetual shares that will be trading significantly lower than what their redemption value is or their liquidation value. And we've illustrated now with 3 companies how you can do that, OTRK.P as well as Regional Health and Washington Prime. Hopefully you've gotten then 3 things out of this video. 1, I hope you enjoyed it. If you did, please hit the like button, and we would love to have you as a subscriber. That is really important to the YouTube algorithm in terms of who gets to see our videos and viewership. 2, I hope that you have seen that this is a strategy that can give you potentially some massive returns in dividends from your investments. And 3, hopefully if you have been opposed to dividend investing in the past, this has given you pause to think, to reconsider whether dividend investing might be worth it to you. Lastly, I hope that you will share this strategy with a young person in your life. You can see how over the long run, if they can pull off these massive dividends for years and years and years, they can acquire significant wealth. Please keep in mind that this is just meant to be a garnishment for your investment strategy. This should not be the whole enchilada. Until next time, enjoy your investing.